councillors haven't arrived, but we are quorate, so we can begin. So we have apologies for absence from Councillor Wason, but not from anyone else, I believe. Thank you. If we could record that, that would be helpful. And are there any declarations of interest? No declarations of interest. Colleagues, just for logistical reasons and to reduce the interference with as many people's evenings as possible, my proposal is that we go into Part B pretty much immediately. We'll come back to the minutes perhaps afterwards. So we will resolve, if you agree to that, in a second, and then we can talk to our colleagues from the Civ first, and then from CBRE second, and then send them all home, and then we'll go back to the agenda. So, unless anyone's got any violent objections to that, I'll propose that formally. Can I ask someone to second that, please? Thank you, Councillor Laurie. So, we have moved to go into Part B. We need to turn the stream off. We're back? Great, thank you. Okay, so reversing the logic, Mr. Peacock, do you want to talk more about the market and things?
Putting some of what Tom's just been talking about in context, the investment market has started to pick up again following the summer. Traditionally, the summer is always a quieter period, and obviously coming on the back of Brexit as well, then we were all very much hoping for things to really get started again, and we are seeing signs of that. There is more activity, but that activity is tending to be in the same areas and same sectors that it was prior to the summer. So the industrial market continues to go forward in leaps and bounds. In the Greater London market now, the yields are down to sub 3%. Nationally, they're at 4%. So at new highs in both areas. Probably as a result of so much demand on the industrial side, there has been a renewed interest in the out-of-town retail, particularly the bulky goods out-of-town retail, and values have really rallied there. Again, 75 basis points in the last 6 months. So, both of those sectors very much in favour. Central London offices is really the only office market where we've seen a huge amount of activity, a lot of it from overseas investors. They've always seen London as a safe haven and continue to do so. Very much a flight to quality, looking in the core West End and in the core city market. Again, yields coming down now to nearly 3% in the West End, which is at the primest it's ever been, and with the city not far behind at 3.75. So lots more activity in those areas, but on the other side, retail, high street retail, continuing to be very unloved, and yields moving out significantly. But shopping centres are equally in a very bad place. But supermarkets, as per our portfolio, very happy with that. That's very stable, very good income flows, very good covenants. So generally, more of the same that we saw before the summer, but just magnified really.
Thank you.
Thank you.
I mean, there's some very strong trends, aren't there, which you've noted in the industrial sector, for example. The Bank of England and others are noting that maybe we are about to see a change in monetary policy. I think the market's now expecting a change in interest rates in February next year. So I suppose my question is, for us pursuing our acquisition strategy, given quite a lot of these sectors have rallied really, really hard, based on various sort of views, fashions, you could say, and given interest rates are about to change, does that mean we should be thinking how do we get ahead of that rather than being a follower and ending up sort of almost buying at the end of the trend? Yeah, if that all made sense.
As I think Tom said earlier, if we're not going to chase these assets down to the levels that the market seems to be prepared to pay now, particularly in the industrial market. We're comfortable with our underwriting. We've factored in where we think the interest rates are going. If those numbers then don't meet the requirements of the fund, we won't be buying, and we will be looking at other sectors. So, we do think the office market is offering potentially more opportunity, and it's just making sure that we buy the right stock in that market.
And I don't know if it's an analogy I can carry over, but in the equity world, I might ask you questions about whether you're a sort of growth or value investor. But philosophically, if that analogy can carry over, where would you be?
Property generally has always been about income, and we should try and make sure that we're looking for that quality of income. We're looking for the properties that will continue to deliver income growth, and not chase yields. I mean, that would be our philosophy.
Thank you. Any other questions, colleagues, on this just introduction piece? No?
Sorry,
yes,
just an interest question. Are you seeing, with the talk that office will potentially be able to be changed into residential, is that kind of creating a renewed interest in premium office, in premium London? Is that something people are looking at?
Well, certainly it's taking stock out. It's taking office stock out of the market because people are looking at these alternative uses and as you say, conversion to residential. So that's reducing the amount of secondary space, and then obviously supply and demand. That tends to suggest that then there'll be more demand for the offices that are left. It's not so much happening in London because it's not allowed there, but in other regional cities certainly it's definitely adding to the supply-demand balance.
Thank you.
Good. Okay, thank you. So as we look at paper A5, there is a recommendation and that relates to the, I'll get the title correct, the Direct Property ESG Strategy. So I think this is probably a joint piece of work with officers and CBRE, so it'd be helpful to, if you could stay and participate in that conversation. Colleagues, I hope you've had a chance to read it in detail. I certainly did with great interest. I had a series of questions, if I may. I might sort of lead off, and then I'll let other people jump in with their detailed questions as well. So, looking at page 5, under Occupational Exclusions, it says that where applicable, it will proceed with caution or indeed reject potential vendors or occupiers with poor commercial track records or who are considered to be associated with undesirable exposure to certain sin sectors. That seems a little vague and subjective, and my suggestion is you just delete that sentence, because were you to bring us a building that indeed was let to someone that we didn't feel met our subjective views, I'm sure we'd tell you and say we don't want to buy it. So I'm not sure otherwise it's...
In terms of, just stepping back slightly, in terms of the drafting of this document, it is very much a draft, which has been presented to the officers for discussion. It's our view of a pretty central down the line kind of suggestion where most investors are going to be around these kind of parameters. And it was then really, we were hoping to have a discussion to debate how the council might like to move one way or the other on a number of these points. So it could be that we pick up quite a few of these things as to where you as a council would like to be, because there's a range of places that you could be on a spectrum on some of these issues. So it's good to have this debate now. You know, let's get the feedback now, and then we can then present another paper.
I'm sure within us there'll be different views on some of these things,
yeah,
and so I don't want to presuppose it. And could you tell me what a green lease provision is? Looking onto the right-hand side of the same page, landlord and tenant, green lease provisions. What's a green lease provision?
Yeah, they've become increasingly popular where landlords require tenants to meet certain obligations or give certain amounts of information about either energy consumption or usage or whatever might be within there. So it's just putting a bit more onerous provision in that the landlord can, perhaps report against, for example.
Okay, no, that's helpful. I think it's now become quite popular. I even noticed the chief executive of St James's Place making this point, that quite a lot of us focus on the E in ESG and perhaps less on the S and the G, because it's slightly harder to get to grips with it. So I'm afraid I latched on the social piece. So page 9, where it said traditional investment methods may need to be repositioned to match the requirements of local communities, and this can be done by both landlords and tenants. And again, I wasn't quite sure what that actually meant. Maybe you can help. I mean, I was just also thinking, would an occupier of a building expect to be accountable to its landlord for? Yeah, it's not normally how landlord acts.
Trying to introduce the concept of more of a partnership between all the parties, the investor, the tenants, the environment, and the people around it, and the impact it's going to have on the local community. Obviously, some landlords are much more keen to take that to the end, to have community groups and have also lots of discussion. Others will be at the other end and not taking into account at all in their decision making. So it's where you want to be on that spectrum, really.
I think I can speak for everyone for saying I'm sure we want to be a responsible landlord, and we would want to make sure the buildings we owned were seen positively by their neighbours in the local community. But it just seemed a bit vague again. And as I said, when it then says that the fund would seek to engage with occupiers to consider their core operations, etc., I'm just not sure how many occupiers would take very kindly to their landlord in talking about these sorts of things. They might have to talk to their shareholders and investors about it, but is it normal that the landlord would come along and start saying, well, I want to talk to you about your policies on this, that and the other? Wouldn't they just say, we're in a contractual relationship with you and it's none of your business?
Well, I think all of these things are changing slightly. I think some tenants also want, they want to have these dialogues with the landlord because they want a sort of quid pro quo with the landlord, where the landlord has the options of doing something in a more social way. So I think, everybody's to a certain extent feeling their way a little bit.
Okay. Well, I would suggest it might need a little bit of tightening up in terms of what we're actually aspiring to do.
Yep.
And similarly, on discrimination compliance, the box below, objective, to ensure that all occupiers and properties are compliant with the Equality Act 2010. Well, it's the laws, of course they should comply, but I'm just a bit nervous that, as you read it, that we would have to ensure that they're compliant with a piece of legislation. That seems a bit of overreach for us. I mean, maybe insofar as it relates to the building, but we're not going to seriously try and audit all of their compliance with every aspect of the Act in their operations as a landlord.
No, I mean, and there are other comments about paying the living wage, and all of these things would be reliant on what the tenant tells you, the information that the tenant provides to you. So I don't think there wouldn't be any obligation to act as in terms of understanding whether they're complying. You can ask the question, though, of them when you want to know, whether you want to let to them in the first place. You can ask them the question in the first instance. Whether you then track it on a ongoing basis is probably more difficult.
Again, I mean, they should be complying with the law and they should be doing these things, but I'm just not so sure. What would we do if they said, no, actually, we're not paying the minimum wage? I mean, they have a lease, so we may say we think that's, well, first illegal,
you're right.
We're going to report you, but there's not much we can do.
It would be limited to when it comes to renewal, or they came to you for something, and that would be the opportunity.
Yeah, I'm just concerned that I think we'd all agree with the intent here, but I just think the way we're phrasing some of this stuff is in danger of overreach, and we're going to, if we actually comply with them with our own policy, we could have to do a hell of a lot of work, and to very little effect, because there's not much we can do. It may be if you tighten the wording to say, at the point where we do have some leverage, namely when we're granting a lease, that we would include this as part of our due diligence, and if we were to find that they weren't doing these things, then we wouldn't want them as a tenant. But for us to potentially over a 10-year period have to enter into really quite comprehensive reporting obligations, what will happen is you won't do it, and then we'll be in breach of our own policy. That's just all I'm concerned about.
Okay.
Colleagues, Councillor Lowry.
I wanted to concur because in that same social section mentions having a diverse leadership group as one of the criteria. But I mean, for listed companies, that's an issue, but that's regulated by the government. It's not our role at all. I don't even know why that's in there. It should be taken out, actually.
Yeah, no, well, I would concur. I mean, I think that's for politicians to decide and debate, and whilst we are politicians in another life, so to speak, when we're sitting in this chamber talking about other things, in this as a landlord, I think I'm with Councillor Lowry. I think it would be very hard for us to impose our sort of political views in that way. So I think this one page anyway, it's just we may need to just do a bit more work to sort of tighten it up and maybe come back to the committee with tighter wording. Sorry, Mr. Hubbard. My apologies. Didn't see you.
I've seen a lot of ESG policies in my capacity as a pension trustee, and this is the first one I've seen that doesn't reference Paris, net zero, or kind of climate action 100 transition pathway, any of these buzzwords, but kind of little talk of complying with Paris or hopefully the Glasgow objectives.
And that's certainly something we can introduce. If as I say, this was a draft document to try to understand what the council's policy was across all of this area. So we're very happy to take other measures that you would like to introduce into it.
Colleagues, I'm conscious, I mean, I have a whole load of points on this, and we could sit here probably doing drafting, and I've only rather monopolised it so far, but you probably have similar ones. So what I was going to suggest is that maybe we could do this remotely by email or something, and then come back to the next meeting having gathered up all of our various thoughts with maybe a revised document. Unless you want to go through now, I'm very happy to, but I'm just conscious some of you need to leave earlier, and I don't want us to get into an hour-long drafting session on this and the other policy, similar policy, and then we miss other parts of the agenda.
But is it possible just to emphasise that the landlord shouldn't be the legislator, which is what this document is trying to do? And I think if someone could come up with sort of a rewrite just to take into account that we shouldn't be landlords and not politicians, exactly what you said, Chair, and then we can look at that as a committee after you've redrafted it on that principle.
Yeah, no, I would support that principle. Colleagues, other colleagues, are you also happy with that as an overarching principle? Yes, I think everyone is. So maybe we'll do that if we're made, which is to, through officers, feedback some of our thoughts. Maybe, you know, if you could perhaps, Mr. Triggs, send us a Word document so we can use track changes and type our thoughts straight into it. I don't know if we can do some clever SharePoint-y thing so people can see what they're all doing, so you don't get 5 different versions. But I just think that might be a quicker way of doing rather than go through drafting now. Yeah? Okay, thank you. Might I also, so this is going to be a really fun agenda. I'm going all over the place to try and keep the logistics efficient. It might be useful if you were to stay and we now talk about the freehold investments, because one of the options for implementation, if we were to go down this route, would be to expand your mandate. So I think your views and opinions could be useful. So that, I think, let's find where it is in the agenda, which was, actually, happily, paper A6. It was right afterwards. So, Mr. Triggs, are you going to start on this one, or are we going to Mercer's?
Thank you, Chair. So this report A6 concerns the grounds rents opportunity, and this arises from the previous meeting where officers were asked to go away and compile a paper on that specific investment class. The recommendation, Chair, is that with total property allocation at 25%, officers have, in consultation with Mercer, have recommended a split of that 25%, with 17.5% to property, 7.5% to ground rents. In terms of the ground rents opportunity, I've set out in the report the pros and the cons of the various options. Mercer have provided as appendices the 2 specific investment houses that offer this investment class. And the report is open to your questions, Chair.
Thank you. So I'm not quite sure who can answer all these questions I have and others will have. So Mercer's, you can probably have a go first, but CBRE, feel free to jump in and disagree, because it's fun listening to different opinions. Helpful. I suppose I had 3, let's just say. One on timing. You know, is this the right time to be doing this, given where the market's got to? The second on availability, if we were to go direct, that's implicitly. And a last question, which we can sort of cover off separately, which is whether we'd actually do this from reducing our cash allocation, because actually I don't see any reason why long term we'd have a strategic allocation to cash. It's not necessarily the case that we'd need it. So my thought is that these are sort of proxies for very secure fixed income investments. I think that's how we got to this place. You've referenced in the paper linkers particularly, but in an environment of rising real yields, if that were to transpire, you'd expect actually these and linkers not to offer you any protection against inflation, and indeed to perform rather poorly. So, and they're very long duration assets, so the price effect of that could be very significant indeed. So it's really around whether the characteristics of this type of investment and the modelling behind it would actually be suitable for us.
Perfect. Yes, thanks, Chair. And yeah, please do feel free to jump in. But I think from a timing perspective, what we had in mind when raising this is as an option for this fund is the potential. You have your liabilities effectively linked to CPI inflation as a fund. So assets that implicitly have a link to inflation in the leases, which these ground rents typically do, are an attractive investment from a asset liability management perspective. So if you do get a period, which is quite possible at the moment, of a rising inflation, the income you receive from those assets would be expected to increase. The challenge you raise regarding index-linked gilts in particular is completely fair. The biggest risk I see to this asset class in general is if you see a significant increase in yields for traditional fixed income assets like gilts or corporate bonds, investors are more likely to buy those than they are to invest in these, and implicitly you get a value drop in these types of investments. Now, the price linkage, the duration linkage effectively of these assets and the sensitivity is lower than from a typical index-linked gilt, but it still exists, and it's a risk to be cognizant of, for sure. I completely agree with that, Chair.
Thank you. Colleagues, I'm sure lots of people. Councillor Bennett.
Yeah, could you tell us a bit more about leaseholder reform, which I think is likely to be coming, and what the risks of that are, and in particular, would that, I mean, are the risks, presumably you would say they're not great enough to avoid the sector completely, otherwise you wouldn't be recommending to get into it, but for example, are there types of ground rents we'd want to avoid, ones with particularly high value or high return on residential, I assume will be an obvious target for leaseholder reform, and also, you know, how that potential leaseholder reform is affecting values in the market as well.
Yeah, absolutely, and great question. So in this paper, we're specifically talking about commercial ground rents. You're right that residential comes with its own regulatory risks at the moment in particular. And I raised this exact question with a manager I was speaking to last week, and not wishing to put words in anybody's mouth, happy to defer to the experts in the room as well. The way they framed it to me was effectively, when you think of regulation in the residential sector, typically you're working with people who aren't experts in the sector, so you're regulating to protect the individual involved, whereas when you're working in the commercial sector, they see a lower risk of that regulatory risk, because they're assumed to be either taking expert advice or experts in themselves. So although the risk does exist, it's deemed to be lower in that instance.
Okay. And then, no, that's helpful. And then the second one was, I think the paper recommended decreasing our share in equities in order to pursue this strategy. And I wasn't completely clear why we would need to decrease our share in equities.
Yeah, so at the current time you have a significant holding in cash, and actually my view is that this asset class will behave more like cash than it will like equities. It's got the element of downside protection, and it's a lower volatility asset class. So whilst you have that cash available there, it's effectively, particularly in a rising inflation environment, there's an opportunity cost of keeping in cash. So for the short term, we'd suggest funding it from that cash allocation. Longer term...
Sorry to interrupt, so there's two different aspects. One is the liquidity aspect, which, as you say, we actually have a very significant amount of cash.
Yep.
The other is the excuse me, strategic asset allocation aspect, which I think what the councillor's question was in relation to. What it felt like to me was, well, you need to find 5% from somewhere, so saying 70% is in equities, we're going to take a chunk out of that. I guess I would, if I may, Councillor Bennett, throw my question in, which is the alternative is take 5% from our cash allocation, given that cash shouldn't really feature in the long-term allocation of a pension fund.
Yep.
Sorry, Councillor Bennett, is that okay?
That's helpful, thank you, Chair.
Yeah, absolutely. The context to this discussion originally is, you know, the fund's seen an incredible improvement in its funding position when we began this discussion, and it's continued to see an improvement in the funding position since that point. And typically, our response to that would be to bank some of those gains and invest in assets with a lower risk than the equity portfolio that you've been running. So from a longer term perspective, banking some of those gains feels to me like a relatively sensible decision to be taking. The nuance that there's cash sat there now, you know, from a tactical perspective, definitely makes sense to use that. But I think that's the decision for the committee. When you see these significant improvements in the funding position, do you want to be reacting to them by banking those gains, or ultimately you are extremely long-term investors?
Yeah.
You have a high propensity to take risk now, given the significant improvement you've seen in the funding position. So there's an argument that you do have.
Aren't you in danger of confusing a tactical decision with a strategic decision? So the tactical decision would be to start trying to time markets, which we've never tried to do because we don't think we're clever enough to do that. The strategic decision is to create an allocation. And then as we come later to talk about the rebalancing policy, that should do what you're talking about, which is as one asset class does rather better than others, it will tend to rise in its proportion in our fund and will rebalance and take profits, which is a sensible, absolutely sensible thing to do. So
Yeah.
I would be very nervous about us entering into the realms of tactically trying to guess and change our allocations to various asset classes based on our judgments on where markets are. I mean, chances of getting it right very, very low.
No, sorry, I should clarify. I guess I don't think I used the word tactical correctly there. I guess what I'm really saying is in the shorter term, you have that cash allocation. So using that to make the commitment and fund the mandate in the short term makes sense. From a strategic perspective, when I talk about kind of banking gains from that improvement in funding position that you've seen, you've obviously got, your actuary assumes you generate a certain...
Why would we, as a local authority pension fund, not seek to discharge our responsibilities to the beneficiaries at the lowest possible cost to the taxpayer?
And by investing to generate the highest possible return.
Indeed. And why do we care about short-term volatility, meaning volatility that occurs within, say, a 10-year period?
Yeah, it's definitely we have a very enjoyable discussion about that exact topic. The thing I would say, I was going to come on to say, is your actuary effectively assumes a certain investment return over the life of the fund. It's about 4% per year. If you see a period where you generate 30% in a single year, there may be an argument to say that you've banked some of those outsized gains.
Which is what our rebalancing policy will do.
The rebalancing policy will rebalance you back to the target allocation that you've set. I guess I'm making the point that you could actually change your strategic allocation in response
tactically, and that's my point. So you're telling us that we should enter into tactical asset allocation, which I'm suggesting to you has never been the policy of the fund, and I wouldn't suggest we enter into that.
That's a perfectly legitimate belief to have, Chair.
Okay. Colleagues, further questions on this investment? Mr. Diaz.
So I guess my question is that, or there are several questions at a very high level, at a strategic level. So how does this fit with the portfolio? So the portfolio currently doesn't have a liability matching allocation. Is the plan to introduce one? How does this allocation then affect the objectives of the portfolio? How does it affect the risk tolerances? How does it affect the inflation sensitivity of assets and liabilities and so forth? So at a very high level, I think that would be important to understand. I think I agree with you, Chairman, as well about I guess the timing and taking a very long duration risk at this time when real rates are at all-time lows doesn't seem like the best of times. And I think that's, I had a third point, but I forgot about it. It'll
come back to you. You can ask it in a second.
Yeah, so I think I think, you know, the benefit to this asset class relative to index-linked gilts is the premium that you get. You get that premium for a reason. You take significant illiquidity risk, etc. So and there is still that risk that markets, you know, gilt yields, etc., do move higher, and at that point, other investors may make the decision to invest in those more attractive assets. And I apologise, I've forgotten what the gist of the. Oh, sorry, in relation to liability, effectively liability risk management. Kind of coming back to the point around being an open fund and a long-term investor, I wouldn't see this as starting a route of liability-driven investing in the traditional sense. It's more saying you don't really have an asset in your portfolio that acts as a low-risk asset other than cash in your portfolio as things stand at the moment, and this does have some liability matching, liability risk management characteristics, particularly that inflation element. And inflation is a real risk in that you the cash that you pay out to pensioners is linked to inflation on a day-to-day basis, whereas traditional liability risk management more focuses on mark-to-market changes based on what the actuary is doing, which is more the domain of the kind of private sector and more difficult and not really necessary for an open fund.
Do you think that a 30-year inflation-linked bond is a low-risk investment? Because the price volatility on those bonds can be quite significant, and sometimes the correlation to equities, at least over the past 20 years or so, has been quite high as well.
I completely agree. I would not sit here and recommend you invest in 30-year index-linked gilts at this point in time, no.
Benchmark for some of these funds is the 30-year linker, isn't it?
Sorry, I didn't catch
the
that one.
benchmark for some of these funds is the 30-year linker, so we have to, I guess, accept that some of the performance might be linked to that.
Yeah, I think the managers using index-linked gilts as a benchmark is effectively giving themselves something quite easy to beat in that instance. There's certainly some characteristics that are similar. But as I say, the price sensitivity of index-linked gilts, and we can put some analysis together maybe for after the meeting or the next meeting that shows the historic performance of this as an asset class relative to index-linked gilts to demonstrate the volatility or protection that this asset provides. Because I don't think it is a fair comparison, although I take the point the benchmark might suggest that managers think it is.
Councillor Bull?
Thank you. I mean, I think it's really interesting to look at this. It's not something I'm particularly familiar with. The one thing that you said that, that someone said in the report that slightly troubled me was about the liquidity, that it's very liquid. And I suppose I'm of an age where I just think there's been lots of bad experiences with illiquid things. And, of course, we're not normally in the Neil Woodford position, but I did, I just wondered, do we really want to be investing again in very liquid things we can't get out of?
Yeah, I mean, again, fair challenge. You get paid a premium for taking that illiquidity risk. You take illiquidity risk in your property portfolio as it stands at the moment, and it's really a question of the quantum. That you wouldn't have 100% in your portfolio in something that's that illiquid, but you are in a fortunate position as a very long-term investor to be able to take some of it. Personally, I feel comfortable at the level that you'd be at 25%, given the rest of your portfolio is extremely liquid. But I don't think you'd want to push it for much further beyond that for the reasons you raised.
I mean, just to correct you on the recommendation, I think it would be 30, but anyway. With
the private equity. Good point.
Anyway.
Thank you.
Mr. Broadhurst.
Chairman, I'll preface my remarks by not talking about the strategic elements, but looking really at, and as I think you know, I'm the world's greatest fan in real estate of a well-structured ground lease. But, and I shall be interested in CBRE's comments, I am of the view that this might be much riskier than it appears on paper. And the reason is that, perhaps I'm old-fashioned, but to me a ground lease represents the value of the land, and there are always two elements to the property investment, land and the building on it. And although they have a limit of 25%, outside central London, there isn't a piece of land that really very often represents 25%. We had this on Exeter, which is an acquisition we're making, and I was convinced that the quality of the land in Exeter was sufficiently high that it was a risk that we could afford to take. But this means has been used to finance real estate because, of course, if you can finance things at 3% or less for 25% of the cost, it is a very cheap form of financing. So my question is, I would want to look at a lot of their assets before I became convinced that this was a fund that was relatively risk-free, because I don't think it is. And if you've got a ground rent of 25% where the land inherently is worth between 5 and 10, and your tenant goes bust, you have a lot of problems one way or another. So I'm not anti, but I am interested in the question of liquidity. Do I get my money back tomorrow? Well, assets don't sell tomorrow, so you don't. And a couldn't find anywhere in here, which I assume they're not borrowing at all, but they didn't say we won't borrow, which slightly worried me as well, because certainly on this type of asset, I wouldn't want to borrow in any circumstances. And maybe you can answer that question that they don't, but I couldn't find it in here. But, you know, I'm quite interested in what CBRE's view as well as yours is on this.
I was going to pass immediately on to CBRE and address that. I think that's okay.
Obviously, we haven't seen the paper, but you get a myriad of different types of ground rent, as you say, Robin. So if you were going down the direct route, which I think is in the paper, then you can choose to go down those ground rents which you feel do meet those characteristics and do give you the protections that you would look to try and find. So I think from our perspective, it's all about the detail of the particular deal that you're looking at and how those values stack up and how the value is weighted between the various aspects of the property. So the devil is in the detail, as it was on Exeter, you know.
I would also add, having bought a few ground rents before for a different fund, you won't be able to deploy as quickly as we could in a kind of, let's say, non-COVID world, but in direct property world. There aren't lots of very good quality ground rents. It does take a while to find them, and so that's just worth bearing in mind. They are used for financing structures. They're put in on caravan parks and, you know, various things that you just wouldn't want to own and touch. So yeah, you'd have to be willing to wait to find the right stock selection for your allocation.
Thank you. Yes, I think there's some good pros and cons of the various routes set out in the paper, which I think that notes it. Colleagues, any other questions, Mr. Davey?
I was just going to say that given that the CBRE have already bought a ground rent directly and you've still got quite a way to invest to your target, that does it need to be a separate allocation? And it looks as though both of the funds that you've recommended, both of them seem to have missed their benchmark by 2% or so on an annualized basis. So neither of them would seem to be attractive from that point of view. So why wouldn't CBRE be able to sort of fill up their existing allocation with more ground rents if they could find them?
I think that's a good point. I mean, my take, listening to everyone and thinking about it as we've been discussing it, is that I think this is an interesting area, and certainly I think we should remain interested in it. As a very long-term investor, there's no hurry for us to gain an exposure. I think Mr. Broadhurst's comments in relation to the funds, which portray an actual expert knowledge of property, which probably the rest of us don't have, or at least some of us I don't have, are also really interesting in terms, and is one of the reasons why we've always been shy of property funds, because you don't really know what they're getting up to. So it would seem to me that CBRE are hearing this debate, and were they in the course of their travels to come across assets which might meet the sort of criteria that we've been talking about, it's open to them to propose them to us. And if over time we were to want to distinguish it in terms of asset allocation, because arguably you could say as has been noted, we've already bought one of these, then we could take that decision at that time. So I think it's a useful discussion, and I think there's various areas where we've asked questions. We should definitely follow up on it, Mr. Diaz's questions, in terms of how it would interact in our portfolio. But I don't think we necessarily need to jump into allocating to a fund at this time. As the committee will know, my bias is always towards going direct, just because I have concerns about these structures, and now overlaid with the additional concern educated by my colleagues. Colleagues, that's my view. You may strongly disagree, but how would you like to play this? Councillor Will's got an expression indicating a point of view.
Any of us feeling, does anyone feel very excited about this opportunity?
You may need to speak in the microphone, at least for the benefit of those who, I'm sure, the very many millions listening to us right now.
It just seems to me that it's a structural. This sounds very like to me structured finance did when things get interesting. It's the devil is absolutely in the detail, and I'm an investor in structured finance, so I'm not against it at all. But I do know that getting into the detail is very important. And for example, what these fund documents don't tell me, for example, what is the average LTV. Where are they investing? How, are they at 25%? I always thought ground leases were, minute compared to the value of the property. These seem to be substantial. So it's a very, it's a complicated area, and every single deal, as you say, is different, and that requires a different type of analysis.
The only thing I was going to say is that the ground lease that is in the current portfolio, it is special because there is that optionality element that if there is a change of use in the land, then maybe we can earn more than what that the current target return, and that makes it quite different from just.
Councillor Bennett?
Just reflecting on the point made that, I think by CBRE, that you don't want to be in a rush to buy ground leases, that there aren't necessarily a huge number of high quality ones around, would suggest that, as you were saying, Chair, that to just make it part of CBRE's remit to keep an eye out for them would make sense. The only counter-argument to that is that I think at a previous meeting we were saying that there are two different asset classes, sort of what CBRE are doing for most of the properties, sort of normal leases versus ground rents, and therefore sort of randomly changing our allocation between the two, depending on what comes up in the market, is almost like allowing an investor to randomly change between bonds and equities. So that would be the only counter-argument.
That's a good point. Mr. Hubbard, I know you opined on this by email several months ago, so I'm going to put you on the spot.
Okay, so I had two concerns previously. One was we had a clear strategy about buying exposure to offices, buying the business, and access to the retail value. It seemed like quite a sort of strange change of tactic to be going for ground rents. I do recognise the comment that there is some upside, but if you come back to a strategic question, we haven't really said whether we want an LDI strategy or we don't. There was a sort of hint of it that one of the benefits are it would give us some LDI cover. If our strategy is to look for long duration assets to try and reduce the risks on our liabilities, then this would be a tool in doing that. If that isn't our strategy, then I question how this fits with the rest of our enthusiasm for relatively high return-seeking assets.
I think that's the right place to start. I mean, this is the paper on liquidity, I think, is very important in this regard, and also the fact that we're an evergreen fund of varying degrees of maturity, but it's certainly not a fund in runoff. So a lot of corporate schemes are in a very, very different place where they're needing to match their liabilities in a much more careful way. In our sense, providing we're not forced sellers of risk assets at the bottom of markets through cash flow, which is we're going to talk about in a minute, then short-term volatility, should be something we should really care about?
Big question. It certainly matters considerably less to you as a fund because of your open nature and your strong funding position and your strong liquidity position. If I may, just very quickly to the point around liability-driven investing, I think where I'm coming from with this asset class is for an absolute return, or for an investor with inflation-linked liabilities, there is no kind of natural risk-free asset that gives you a reasonable yield at the moment, given linkers are effectively off the table. This is as close as we can get, but we're not suggesting this as a start of a dedicated LDI, liability-driven investing strategy.
The risk of sounding like a pension fund chairman of old, maybe I am, don't equities do exactly that? That actually they're the best asset class, maybe alongside property, but certainly equities over the long term, because you're buying real assets, and it's by buying real assets you've got the best protection against inflation. Any contractual cash flow is going to be jolly hard to meet it. I absolutely, of course, understand equities can be incredibly volatile short term, but over 20, 30, 40, 50 years, by buying real assets, you will have protection against inflation.
Historically, that has undoubtedly been the case, and this funding position is testament to that fact.
Good. I think what I'm hearing, I'm going to draw it to a conclusion, is that this is an interesting discussion. I like the formulation that were CBRE to have to encounter something of interest in this space, they should at least alert it to us. But I absolutely think that the points made around a strategic allocation by Councillor Bennett and Mr. Howard are important. So I think what we shouldn't do is drift our CBRE investing strategy into this asset class without it being a very conscious and distinct decision. I think there's a good points made. But they've heard the debate. So if they were to see some very special and Broadhurst compliant a type of ground lease, then they can bring it to us and we can have this discussion, albeit sometimes when it's through a sale process we might not have time to thrash it to death. But thank you, I think it's been useful. Good. I don't think there's any other aspect of our agenda that we need to hold you up for. So thank you very much for being here for those bits.
Thank you.
Thank you. So I'm going to go back to where we normally start and go to the minutes of our meeting, very unusually. So colleagues, you have the minutes. Were there any corrections you wished to make to those minutes? No? Matters arising to the minutes. I think there were one or two. So we're looking at the rebalancing policy later. Mr. Triggs, maybe you can talk to, I think it may be coming up in the rebalancing paper, but in terms of the execution of the rebalancing of the Bailey Gifford Fund. Do you want to just cover it now? It does cover in minutes. So.
It is included in the investment report, Chair. I can fast forward to that if you like.
Oh no, okay. Hold on, you may as well do it then. Sorry, I'm not helpfully. We have a paper on the cash flows, so that's page 14, and the annual costs of the SIV again comes up later in the agenda. Looking at the action tracker from February, looking at it, the passive equity provider, Mr. Triggs and Mercer were asked to undertake further due diligence, especially in relation to stock lending, report back to the committee to be cross-referenced to presentations and issues raised at the meeting. I propose that you maybe talk to that point when we get to our passive piece. And then there was an action on CBRE, but they've disappeared, so we'll ask them again when they come next time. I don't think it's particularly urgent. Colleagues, were there any other actions or matters arising from the minutes that you had spotted that you want to raise? No? Okay, well I propose that we accept the minutes. Is that with your concurrence? Yes? Yep. Okay, the minutes are agreed. Thank you very much. So shall we talk about paper A7, the rebalancing policy? Mr. Triggs.
Thank you, Chair. This was considered at the previous meeting of the committee. It is the committee's wish that a rebalancing policy should exist that lowers the risk of asset allocations growing out of kilter with policy, and to find some method of agreeing a way in which anything that's grown out size should be brought back to the policy asset allocation, but done within an optimum means so as to reduce cost and risk to the fund. So the way in which we've considered that factor in the last couple of months or so, we've obviously taken advice from Mercer the Mercer report is attached as an appendix. Basically, the recommended approach is that tolerance limits should be set that are reasonably wide instead of being unnecessarily prescriptively narrow, and for officers to bring information as regard that asset allocation to the committee on a quarterly basis. So those tolerances to be used as a guide, but not applied in any formal, rigid fashion, monitored on a quarterly basis. So I'm happy to defer to my colleague from Mercer in terms of his report, which is included as the appendix.
Thanks, Mr. Triggs. The paper in the pack is relatively similar to what we presented at the previous meeting. We've added some, I guess there were a couple of concerns raised at that meeting regarding firstly the frequency of rebalancing and secondly the potential to rebalance too quickly and potentially miss out on momentum on upside. So we thought it would be helpful to pull together effectively a back test of your current investment strategy to see how often you would have rebalanced and at what point you would have rebalanced based on your specific investment strategy, assuming the property allocation was fully implemented. And you can see from the pack that rebalancing would have occurred on 3 occasions. It would have been beneficial from a risk perspective. But over the life of the analysis, which we conducted since 2007, because you were largely de-risking out of equities from a return perspective, you were slightly worse off effectively from de-risking from equities into lower risk assets. Happy to take any questions on that.
Thank you. I think last time we were sort of quizzing you around this. I'm not sure we quite got the answer yet. If you think about it, what you're proposing is actually not very different. These are degrees. Were we to go for something which was periodic rebalancing at a particular calendar date? Because, for example, the proposed policy here is silent on when the tests would be applied. So would it be when we met? Would it be on a quarterly date, in which case how from a governance perspective would we act on that without it becoming discretionary? So for example, if we were to say the quarter day, well, we're meeting on a quarter day today as it happens, but most often we don't. So as you think about it, if you were to specify any of those things, so it is a quarter day, well, that's now just creating a fixed point in time at which point you rebalance. And then the question about whether we adopt tolerances or don't adopt tolerances, again, is a matter of degree. One could either have no tolerances, in which case at every rebalancing point you do the maths and rebalance pretty much every time probably. Or with this tolerance you tend to rebalance less often, as your analysis shows. But actually they're not actually that different. And I suppose my question to you, which is the bit I don't think we've still quite answered, is I think most of us would understand very clearly why rebalancing is sensible. We've talked about it earlier. But from the work I've seen, which I wanted to share, but it's actually commercially sensitive, there is some momentum effect from allowing asset classes to run, if I can put it that way, before you rebalance. And so the question would then be, what's the optimal period for that, and then what's the mechanism for being disciplined and rebalancing at the right point without losing that momentum effect?
Yeah, and I think that's the. I think my view would be into the initial point around what we were trying to avoid by steering away from calendar rebalancing is exactly the issue you raise of rebalancing just for the sake of rebalancing and incurring unnecessary transaction costs, and the introduction of the ranges we believe addresses that challenge. I think the point around kind of momentum and potentially rebalancing at the wrong point in time, I think it's difficult to square the circle between wanting to capture that whilst wanting to have a relatively rigid framework, because you need to understand you need to identify the point at which momentum switched, and you need to have an idea of how long you expect it to last. And my view is that at that point you would be introducing an element of discretion, which the rebalancing policy is trying to avoid.
Absolutely no, but I mean, one can, because I can tell you, because I've seen it in another place, one can adopt rules that captures that momentum effect without introducing any subjectivity. I absolutely agree. I mean, also, I think you mention it, but I think this still does feel like it might still be subjective, because if it were done on a committee calendar basis, potentially at that point people would start going, oh, I'm not so sure. And I think we've been doing that recently. We remember our recent debates, as opposed to something which is binding ourselves to something which is almost automatic, because we've determined that that is actually the right thing to do. So trying to avoid us fiddling with it at the time and all saying, oh, that looks like the wrong thing to do, and following our rules.
I completely echo that, your second comment. I agree that once we've agreed a policy, we should stick to it rigidly. I take the point regarding, you know, the way this committee and most committees work in terms of monitoring is to do quarterly monitoring and discuss. You know, it takes a period after quarter end for you to know where you stood at quarter end, and we discuss it typically in these meetings. I think within the current governance framework, we would be recommending, again, you use the quarter end figures and you come to, you make the decision at the committee meeting. But if we can effectively take these rebalancing ranges as rigid, then that the discretion could then sit obviously with officers to be able to rebalance ahead of having to meet. And your rate limiting factor in that case is simply the availability of data at quarter end.
Yeah, I mean, that instinctively feels like, I'm not sure from a governance perspective we might be able to. It doesn't feel quite right that we delegate that level of responsibility. Also, we do have some, as we've talked about, some illiquid asset classes. So I do take your point around ranges that otherwise, with those illiquid asset classes, for example, private equity, if we were to be 0.1 percentage point above and attempt to rebalance we just can't. It doesn't work that way, or property the same. So one other question, sorry colleagues to monopolise this, but you're, I think, recommending that where you get to a trigger level, you come all the way back to the middle of the range, and it would seem to me more logical that if you get to the top end of your range, you just come back to the top end of the range. Otherwise, it's a slightly peculiar policy where you've got, I don't know, what do we say for equities? 5%. So you're at 74.9, you do nothing, and you get to 75.1, you go all the way back down to 70. It seems to be a bit of a sort of cliff edge, rather than you allow it to meander as between 65 and 75, and if it gets to 75.1, you come back to 75, and if it gets to 64.9, you go back to 65.
Yeah, and again, I think that's a trade-off between the transaction costs, effectively, of rebalancing a little more regularly, and the risk management.
It shouldn't be any more regular, because if you've got to 64.9 or 75.1, on your analysis, that happens very, very rarely. It would just be whether you sell 0.1 or 5.1, or indeed buy 0.1 or buy 5.1.
Yeah, so we would be suggesting, as I think you made the point, suggesting moving back to the middle of the range, the target asset allocation.
Yeah, but that's my point to you, is that seems rather arbitrary.
Well, I guess you set that target asset allocation for a reason, and with that in mind, it seems like the natural place that you'd move back to after when that particular trigger is hit. I think if you were going to rebalance to a different point, then I think the discussion would be, have you got the right strategic asset allocation in place at that time?
No, but I'm saying you would rebalance to the upper bound of your policy. I think it would trigger, if you were bouncing around that number, yes, you're right, you'd potentially have a series of smaller trades rather than one large one. That would be a consequence. Yeah. Sorry, colleagues, I've monopolised this. So, Councillor Bennett.
Thanks, Chair. Well, I have two questions. So the first one is just going into more detail on those illiquid asset classes, private equity and property. So taking them in turn, private equity, firstly, sort of how confident can we be that these valuations are accurate? I was sort of reading up on this online, and there are a number of experts in the field that say, we haven't got the quote here, the ultimate performance of PE funds is only known once all investments have been sold and cash returned to investors. And PE funds have a tendency to overvalue their funds, particularly when they're trying to raise additional funds, and because they're not traded assets, how confident can we really be that their valuation is correct? It's something we sort of get into for the long haul, and I kind of see logic in just seeing that through. And if you're selling off PE because they're not tradable, what's the risk of getting quite a bad deal on that, or even affecting the sort of value of those non-market assets that we hold? Because we're quite a big pension fund. If we're selling things off, we might be selling half our stake in a company, and that might actually devalue the company. So that's sort of my concerns on rebalancing on private equity. And then on property, CBRE said earlier, property is about income. Again, and maybe I'm looking at this wrong way, but I sort of think with property, we're saying that the valuations, capital, increase in capital is nice to have, but we're in it for the rents, and we get into, again, something for the long haul, for 20 years, 30 years in a lease, and capital valuations might go up. Is that really a good reason to be rebalancing? So that's sort of specifically on just going into more detail on those two illiquid asset classes, which you did touch on in your report. And then my next question was just on, and Chair, you might have views on this, on evidence that rebalancing does actually increase the long-term value of an equity-heavy fund like ours with a very long-term view. I know you said that sort of just looking back since 2007, rebalancing the portfolio would have actually decreased the value of this portfolio. Is there evidence that in the very long term, rebalancing is good for value of funds like ours? So two quite long questions.
Perfect, yes, thank you. So yeah, I'll start with the question around illiquid assets. So for private equity specifically, you get some quite helpful sort of natural rebalancing from that asset class, because they're closed-ended funds. You're putting cash in, it's deployed, and then you get cash out over time. And we can use, the cash that's available in the fund to, you can't get it perfect at a particular point in time, but you have sight over the future, so you can increase your commitments or reduce your commitments. I can't think of a scenario where we would recommend that you sell your private equity assets. You don't need that level of liquidity, so it's more keeping it topped up.
As the cash becomes available makes sense to me for private equity.
Yeah.
More than selling it off. Sorry, yeah.
Yeah, and in relation to the property portfolio, you make the point that, again, that's an income-generating asset. That's where we expect a proportion, potentially the majority of the return to come through for that portfolio. Over the long term, we'd also expect property is likely to underperform some of your growth assets, particularly your equity portfolio. So over time, if we look at history as well, you'd have been topping up your property allocation rather than disinvesting. And again, if we did see a situation where you move due to it would likely be due to an equity sell-off that wasn't mirrored in property markets. If we did see that situation occurring, then you certainly wouldn't be instructing a fire sale of your property portfolio, but you might instruct your manager to not invest in new assets, depending on how fully invested your portfolio was at that point in time. It's a very valid challenge that rebalancing is more of an issue for a fund like this, where you have a significant allocation to illiquid assets and a portfolio that's heavily invested in equities.
I think Councillor Bennett had a useful question which you can answer either subsequently or at the next meeting, which is for the members of the committee to see some paperwork on why rebalancing in principle is a good thing. So we're sort of, having taken that slightly for granted, I think it's a good challenge to say, well, is it the right thing? Colleagues, what I would also suggest is this: we have actually talked about this, I'd say, at least 2 or 3 times in my chairmanships over the last 6 years. And I think what happens is we talk about it, we agree it, and then we forget that it's embedded in a paper way back when, and then we come back and say we ought to talk about it. So as a very simple, perhaps, next step, could we actually turn this into a policy paper, which then sits on the shelf and we say we know where it is, and we don't have to keep saying to Mr. Triggs, can you please go and look at our minutes from 14 years ago to try and, or and all the subsequent changes we've made, which is just sort of trailed through minutes. So there is actually a document, and then in that document you can sort of perhaps just tighten up some of these things that we've been talking about, or at least propose what you think the right answers should be, and we can debate them, and then that is the document. There's no urgency. I think this is very, very important and a good subject to discuss. We can get it right, because it's not going to result in any actual actions in the short term, not unless markets do something very weird. So could I perhaps leave that as our interim conclusion? Yeah, good, thank you. So let's move on to paper A8, if we can, which is all the lovely quarterly performance review documents we've got, which I'm sure everyone's read in absolute detail, or maybe not. There were actually, I think, there was, trying to find it. Where's the yellow tab? I think embedded in it, there was actually a recommendation in relation to private equity, right at the very end. It says for noting, but actually...
Yes, Chair, that was the research paper on the appropriateness of private equity within a strategy.
Exactly, I think it's in 8.5. So the committee was invited to discuss future potential private equity commitments as the 3-year rolling $10 million subscription agreed in 2018 has now completed. Gosh, it feels very recent, so time has flown. I think actually coming out of our discussion around allocation, unless we're choosing to change our allocation, implicit in that is that we need to continue to allocate fresh capital to this, because as has been noted by Mr. Rafi, it auto-liquidates. So colleagues, I don't know whether you feel at the moment you want to discuss and go into the detail of whether we should continue our allocation of private equity, or you're happy to take that as read. But I would suggest to you, if you are happy with the allocation, and you may want to discuss it, and in which case I'd suggest we do that at the next meeting, because that's quite a big subject. But if you are happy with our allocation, the implication of that is we need to recommit, otherwise our allocation will go down as just a mathematical fact. So I will take your instruction. If no one speaks, I'm going to suggest that we are happy with our allocation, and therefore we should calculate what commitment we need to make. We might invite Adam Street to come. Councillor Bennett, or Mr. Howard.
I wasn't unhappy per se, I just wondered why it was so low.
Ah, another interesting comment.
With our very long-term perspective, surely it's a place to be putting risk capital.
I can't think how to answer that succinctly. I think, again, fair challenge to make. There's considerations in private equity around risk, fees, and illiquidity as well. If it's a topic the committee would like to discuss, I can happily prepare a kind of paper on how we ended up where we do and why we think it's an appropriate allocation for the next meeting.
Yeah, I think that would be useful. No harm to think about it, and both at that strategic level to answer Mr. Hubbard's question, which I think is a strategic question, and then also the tactical question around exactly were we not to change our allocation, but just seek to maintain it, how much would we need to commit, etc., etc. So there's a decision somewhere, but I think there's a useful debate to be had around private equity. We might get Adam Street along to talk to us if we've got time in December now, isn't it? Let's see. But if we can, maybe they should come along and talk to us about what they've been up to anyway.
On that question, Chairman, with regard to 5%, I can't think of any LGPS fund in England or Scotland or Wales that have anything higher than 5% in private equity. It seems to be a standard allocation.
But yes, you're tempting us to be different, just because we're quite keen sometimes to do that. No, but I think it's a good. Let's discuss it. I suggest it's a very rich area to talk about, but we probably can't do it justice here now on at this point. Colleagues, the other thing I spotted in, this is perhaps, I think, the moment to talk about the rebalance update, and particularly 6.3, I just didn't really know what this meant. In terms of the time out of the market, as the fund moved to cash, the 3-day settlement period was not an issue. I think time out of the market would mean we sold our assets that, which were going up and down on day whatever, and if we weren't in the market for that period of time, if the assets went up, we'd be unhappy. If they went down, we'd by luck be happy. But it would be understanding, ideally, we shouldn't be out of the market at all. We just transition seamlessly. So I wasn't quite sure, understood that point. But maybe you can cover off more broadly, just update us on how the rebalancing went.
Thank you, Chair. Thank you, Chair. So this was a recommendation, well, an approval of recommendation at the previous committee in terms of rebalancing. So the before and after allocation is shown. The before in paragraph 5, which showed Bailey Gifford to be 5% out of range against the target allocation of 20%. So officers took some precise instructions in terms of how that transition process should be managed, and it was of the officers' wish to get this transacted as quickly as possible. And the outcome, as shown in the paragraph, the table in 6.4, we rebalanced the Bailey Gifford allocation to 20%, and that was a valuation at 31st of July of just over 306 million. I apologise for the vague line in the in 6.3, which is time out of the market, because as you say, with a normal transition process, you're transitioning from one asset class to another, and you're measuring time out of the market, which obviously in this position, it was a straight transition from equities to cash as at the transaction date, which was the following week, commencing 12th of July. In terms of the cost, that's mentioned in 6.2, the mid-spread of 0.11% was equivalent to a cost of just over £88,000 in terms of that transition. So the outcome is shown in 6.4, Bailey Gifford 306 million at 20% of the total portfolio valuation, and the Algym Sterling Liquidity Fund increased from 208 million to 288 million. Obviously, the purpose of that fund is to finance the property purchases as they draw down into the future, and pending any further decision by the committee as to how that quite large cash position should be managed. Thank you, Chair.
Thank you. That's very helpful. Were there any questions or comments on that piece? No. Good. Anything else on paper A8 anyone wishes to raise? No? So let's move on to paper A9 on the cash flow forecast, which is for noting. Very helpful. I think, I don't know if the pension board has seen this, but I think that might be one to send in their direction too, if they haven't seen it already. I immediately spotted just a couple of things. One is, it says our bank account has got £2.6 million in it, and just in case anyone hadn't quite remembered, we have £280 million in a cash fund, so of course we've got lots and lots and lots of cash. And also worth saying that whilst this shows cash coming in and out of the fund, the vast majority of our assets, notwithstanding the comments we've just talked about, private equity and property, are in equities which can be liquidated very quickly. So we remain very liquid relative to the likely liabilities we may face in any given week, in any given year. So I think, but this is definitely helpful in relation to the conversation we've been having around the ground rents and all the other things, because we're not in runoff, so we're not systematically in negative cash flow. But colleagues, I don't know if there's anything else you just wish to note. It's a paper for note. Are you happy to move on? Mr. Diaz?
I was just going to say that it's a very strong position to be in, because almost all outflows can be covered from just rental payments once the property portfolio is fully built. So it's probably one of the strongest pension schemes that I've seen. And
so the way we like it. Colleagues, any other questions or thoughts or anything on this? No. Okay, good. Well, we've noted it. Thank you. I think it's very helpful. We should keep an eye on liquidity, please. I think it's a good one that periodically we just as good governance that we do look at. So let's move on to paper A10. I'm going to immediately jump in and say I suggest the same logic applies to this as applies to the property one, because it's the same sort of thing. So if you're happy, circulate by email comments and then come back to the final draft once we've all added our 2 pennyworth. Is that okay? Yeah? Good. Okay. The paper A11 on the London Civ funding charge. Mr. Triggs, did you want to talk to this?
Yes, thank you, Chairman. So this is the London Civ Development Funding Charge. In terms of its mechanisms, the members will recall the signing of documentation at the previous meeting in the previous year, and there was an agreement that was agreed by the Cabinet Member for Finance at RBKC in terms of the general fund funding anything above a CPI increase on the existing charge, and the general fund committing to make that shift of funds if that was necessary. So this paper concerns the outcome over the previous year, 2021, and the DFC cost originally at 65,000 in the previous year, 1920, increasing to 85,000 in 2021. So had this increased in line with CPI, 1.8%, then that charge would have increased to 66,170. So you can see there is a considerable increase above the level of CPI inflation. So I've deferred to my colleagues in legal just to check the wording of the agreement approved by Councillor Will, and it would appear that there is grounds for asking the General Fund to make this adjustment in terms of that charge. I should mention also that it is the officer's view that in terms of that increase in charge, the consensus of opinion is it's really down to the London Civ's assets being managed has grown at a lower rate than originally envisaged or desired, and so therefore there is obviously much less of an asset base on which these charges can be spread, and obviously with a lower asset base, the income that the Civ generates in its own revenue account is less than anticipated. That appears to be the main reason for this increase in charge. So happy to take any questions, Chairman. Thank you.
Thank you. So has Councillor Will got her chequebook out, or are we going to have to remind her to do so? I mean, as in, a serious point, has this actually occurred, or has it not occurred?
No, this has been brought to for the attention of the committee, and if it is the wish of the committee that we go to Councillor Will and make this request, then I will do so, Chairman.
I don't think we have any choice. We have to act in the interests of the fund, and this was the agreement we reached last year, so absolutely we should see this transfer executed. I suppose I would add, I think we need to do this sort of on an autopilot. Mr. Triggs, do you remember that very helpful business plan that you produced? What I'd suggest is that this aspect, namely calculating how much each year the General Fund has to make as contribution, should go onto that business plan, and so that whenever month is appropriate, we do the calculation, because it's going to be the best part of, well, even if it never increases again, it's going to be the best part of £19,000 ad infinitum, until, well, inflation will slowly catch up. But yeah, I think this should be a relatively uncontroversial administrative matter. But colleagues, you'll remember we had lots of fun negotiating all of the things around the Civ, and we managed to get ourselves into a place where we managed to agree it on the basis that if the Council as a whole, using its wider discretionary powers, took the view that entering into agreements that we did was in the interests of the Council as a whole, that was the prerogative of of the council as a whole and the leadership team specifically, and therefore provided that we protected the rather narrow interests of the fund, if they wished to reinsure us, so to speak, for that decision, that was up to them. And so that was the decision they took. So they've agreed to underwrite that, the consequences of that, and that's what this is. So I think it's important that we follow through on it, would be my view. Councillor Will, is that? Indeed, but it should be for note because it's already a key decision, and I think this should be on autopilot.
This is just for our information. It's really nothing to do with us. No.
It is nothing to do with us, and we're just looking forward to the check in the post, I think is all we need to minute, Mr. Shepherd, in very technical terms. Good. All right. Thank you. Investment manager review. Did anyone want to talk about this? We have so few, and we're not proposing to make any changes. And I suppose I'd see this as just more a statement of comfort from Mercer that you're comfortable that those managers that we do have, really only one, and really for equities anyway, is fine.
And we would raise proactively with the committee and with officers if anything were to change in that respect.
But colleagues, did you have any questions on this report? It is very important. To the extent we've allocated money to a manager, we have to keep them under review. We don't have that many of them, but no, no comments. Good. All right, we will note that. Thank you. Paper A13, the passive equity mandate. Now again, we did lots of work and thinking and analysis of this, but we rather kicked into touch whether we wanted to do anything. So this paper, I hope, brings it to a conclusion when we're about that. Mr. Triggs, did you want, well, I know you've got some interesting late news to impart on paper A13.
Yes, thank you, Chair. This paper, again, from a request from the previous committee to look at the possibility of changing managers in respect of the passive equity mandate currently run by Algym. Members will recall that BlackRock made a presentation to the committee the year before and made a compelling case in terms of their abilities to run a passive fund. There were certain factors that the committee and you, Chairman, brought into the decision-making process, one of them being the unfortunate performance of Algym in terms of their response to previous transition requests and a less than optimal outcome in terms of the transition process that they did run and the unfortunate timing in which it took place. So that was a factor to be considered as to their future relationship with Algym. Paragraph 3 looks at the particular funds that are currently tracked. So there are differences in the various indices used. And the paragraph also sets out the total expense ratio of each one. Now, with regard to BlackRock, the initial indication was that they would make a charge of 1.35 basis points in terms of the main passive equity funds being managed. Since that particular offer, they've reduced very, very slightly to 1.34 basis points, which would, I think, result in probably for the LGPS being the lowest fee that they would charge an LGPS fund. So that is it's worthy of consideration, Chair. In terms of ESG considerations, at a meeting of the local pension board yesterday, the chairman, Councillor Williams, asked that we, as a committee, should take in consideration the responsible investment and ESG factors associated with each manager. And we have, as officers, we've looked extensively at the websites of each of the managers, making a judgment that they're, in terms of their processes on company engagement and shareholder voting and screening of investments. At the moment, and I think Mercer will concur with me, I think it's Algym that has the slight edge in perception, being that they are slightly up on ESG and responsible investment considerations. So that is a factor that we, as the committee, should consider, and specifically mentioned by the local pension board at their meeting yesterday. So really, Chairman, it's for the committee to make a decision at this meeting if it should wish to make that switch from Algem to BlackRock.
Thank you, very helpful. I'm going to put my cards on the table and then you guys can all disagree. I think we should change, and I think the reasons for that are, firstly, BlackRock are cheaper, slightly cheaper still, given the slight reduction you've secured. Secondly, I've lost faith in Algem, given their performance on both occasions that we've asked them to do something. Arguably, whether we would be doing any more rebalancing with them, who knows, but their general responsiveness to us and their execution and their ability to explain to us what they got wrong, I thought was poor, and when you've lost faith in a manager, I think that's a good reason to cut them. And then my subjective opinion is that and I think it's very right for the pension board to have raised this, but their ESG activities, I think, are not good. I think they've adopted various positions which may or may not represent various people's views, but they've entered into very subjective debates without actually consulting those of us who are actually the stewards of those funds, and I don't think that's appropriate for them to have done so. That's my particular view. So those would be my three reasons. I think you rightly identify the grounds on which we should consider it, and that's how I would answer the three questions. But colleagues, you may have a completely different opinion.
Chairman, I seem to remember there was a difference on the treatment of stock lending, that LG passed that to the underlying investors, whereas BlackRock kept it for themselves. So that might explain the difference in fees.
Not quite. They allocate different proportions back to the investor. So you're right, Algem is more generous in the proportion that goes to the investor versus BlackRock, who keep a larger share.
But has that difference been reflected in the fee figures here on Section 5?
No, is the answer. But those funds, those, as you know, are not guaranteed. Those are, Mr. Triggs rightly raised this with me, so that's open to you. If you believe that Algem, which on the current numbers would deliver a slightly higher and compensating return from stock lending than BlackRock, and therefore in total, that would offset the fee differential. If you're happy to rely on that and that's a material factor, I think that's an entirely reasonable position to take. As it happens, I don't, because I don't think that you can rely on that stock lending revenue being persistently in their favour. Mr. Diaz?
Mr. Chairman, I guess it's more of a question for Mercer, but should there be some limits on concentration on a single manager? Because it feels that having 70% of the assets in LGM or BlackRock, for that matter, just is too big of a risk.
Possibly. I mean, not so much from the underlying asset, but more just in case the manager's got something operationally wrong.
Yeah, and I think it depends on what that manager is doing for you. Passive managers, because they're tracking the benchmark, we believe the risk is relatively lower of something going significantly wrong, and you can afford to have a higher allocation to passive managers. And as is set out in the report, both BlackRock and LGM effectively have the scale and expertise that we have extreme confidence that they'd be able to deliver that passive management on your behalf. So for this particular mandate, we don't have a concern around concentration.
There is also the matter of the Rafi Fund, which, as you rightly point out, is not directly transferable. And my thought on that was that we should exclude, if the committee might agree, it may not, but that we should exclude that for now, and actually it would be a good time for us to have another look at that, because we haven't looked at it. It was Mercer's sole recommendation, so we'll be interested to see how it's come out. But rather than mess around with that, I think we better to understand it. But Councillor Bennett, did I see you indicate something? So I would suggest that we limit any decision to the broader just MSCI World bit, and pause on any Rafi thing until we've sort of thought more about whether that's still the right thing to be doing. So it wouldn't totally exit from LGIM at this point if we were to follow my thoughts. Colleagues, I'm going to be provocative. I'm going to propose that we move the MSCI World element of what LGIM has to BlackRock. Do I see anyone who is not happy with that decision? Would anyone else like to speak in the other direction? In which case, can I take it as your assent that that's what we ask officers to do? Subject, I think, to the normal caveats around transition management. You've got used to this by now, but hopefully this should be very straightforward because it's passive to passive. And there should, I think when we spoke to BlackRock, there's a very small element of risk in terms of what might happen to costs. But you might want to just kick the tires on that and just come back to us if you're not entirely comfortable with BlackRock's answer and the costs of it. If it's going to become material, then come back to us. So, colleagues, I think, can we resolve that? Yes, I'm seeing assent from everyone. Thank you. Good. I think that gets us to AOB. Is there any AOB from anyone? No. Good. In which case, slightly past 8:30. I need to sign the minutes. Oh, Mr. Shepherd's got something important. Yes, I will. I will. I'm going to be careful how I phrase this. So, sorry to ask you to move the date of the next meeting. That's entirely my fault. As you will have noted, we're intending to hold a post-meeting event. I'm not going to go much further than that because you'll probably gather why. So I hope you can both attend the next meeting. So thank you for moving it into your eyes. But I also hope you can attend the post-meeting event, which will be rather a nice thing to do anyway for all of us in December. It's a good time of year to have for all of us to get together. So thank you, Mr. Shepherd. Good. Thank you. I need to sign the minutes.